Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another weekly Roundup edition. Today, I'm joined, as always, by my co-host, the patient, Mr. Marston.
Patience.
We had some tech problems this morning.
Yeah. Look, I don't use this word very often, but I hate Microsoft with a seething passion. I mean, I hate them. I have been locked out of my computer for a week. I've tried multiple tech people. It's because they don't want me to use an Apple product. It's like, that's not your choice. And it's unbelievable. It's absolutely, anyway. So
it's that ecosystem lock-in, baby. It's a powerful
I found
thing.
a workaround, ecosystem lock-in, just crazy. Anyway, quick reveal. So I got the green candle pants on today, not the orange. And I went way old school with the original yellow Bitcoin. These are like my original Bitcoin sock game from kind of 2013 or 14. I can't remember which year I got them, but we're going way old school. Big green candle this morning. I think lots of green candles incoming. January 8th, the King's birthday is the day. That's the day of the approval that's going to happen. And you heard it here first. So
starting off with a bang here, Mark.
I like it, baby.
I like it.
I missed it. We didn't do this last week because we were suffering from tryptophan coma, and I don't know. We got to cram 2 weeks into 1 week this morning, so we got to get going.
All right, I've got a quick London fact for you before we dive into the back. You know what? I'm going to reverse the order here and actually start with some Bitcoin stuff because I wanted to get your take on this. So, London fact for you. So, London was founded back in 54 AD. Londinium was the name, and back then, just as a little history fact for you, this was one of the provinces of the Roman Empire. So Rome had these provinces where some of the wealthy patricians looking to make a name and frankly a lot of wealth for themselves, they would go out, they would leave the city, they would run these military campaigns and be a governor of different regions. So Caesar famously did Gaul and Cisalpine Gaul, and London was one of these. And they went back. One of my favorite facts about this is they went back and they found some barracks from like really ancient times back in London, and they found some inscriptions that the soldiers who were fighting would kind of carve in.
Yeah.
What was on there, Mark?
Get off zero? No, I'm just kidding.
Yeah, exactly. Your mom jokes. They found that from like 2,000 years ago. Your mom jokes. And
wow.
You can interpret that in one of two ways. That just makes me smile because I'm not condoning your mama joke or not. It's just like people don't change.
Humans are going to human. And there is nothing new in this world. I talk about this all the time, right? There's this guy, I think his name's something Maxwell, but he's written all these, management kind of books. They're just quotes from Seneca and Socrates. It's just, there's just nothing new in this world. And to your point, It's, 2,000 years ago, people were doing the same, poking fun at their friends or making fun of their, friend's mom or whatever. It's just the way it is. Humans are going to human.
It is. Humans are going to human is really great. So there's your London fact for you. London's been established for a long time. New speakers, we got signed up. Marshall Wace, big hedge fund over in London. KKR signed up. I'm blanking on one other one. I feel like we already announced this, but BlackRock sending a speaker as well. So great speaker lining up. Come join Mark and I.
Paul Marshall and Ian Wace are two of the coolest guys. And there's a lot of people at that organization now, but
I always forget that you just know everyone.
But it's just because I'm old. It's just because I'm old. But Paul Marshall and Ian Wace were one of the very original London hedge funds. And I'll never forget this. It's so fun. So the way I used to do it when I was, young and just getting started in the business, both at Notre Dame and then at UNC, is I would take these trips and I would go to a city and I would book 8, 9, 10 meetings a day. And people say, that's not possible. Like, well, I would have breakfast and then I'd go to multiple meetings and I'd have lunch and do a bunch of meetings and I'd go to dinner and I'd have a drink. So yeah, I would meet a lot of people and I do, 40 plus meetings in a week. And in those meetings, one of the things I would always say is, hey, is there anybody else that I missed? And I was talking to this one big hedge fund, one of the precursors to Brevin Howard, actually. And long story short, they were, because they had done well already, they were one of the partial owners of the Chelsea Football Club. And he says, well, I was in the box the other week and I met this young guy who's spinning out. And I think they're getting ready to start up. And like, great, can I meet him? He's like, well, let's find out. Let me ring him. And so he brings, because they say, let's ring them up. It's not, let's call them, let's ring them up. And so he rings him up and he says, well, I don't know if our office is actually open, but yeah, we were going to go check on it and see. And so have them come by. So I went by after lunch and I met these two young guys and the office was full of boxes. Like, come on in. And we literally sat on boxes and had our first meeting with Marshall Wace, and they crushed it for a couple decades. And now they're a big family office and cool guys, really, really good guys.
All right, everyone, we will be back to the program in just a moment. But before we do, I wanted to give you the inside scoop about something that we've been cooking up at Blockworks these last couple of months. So in March of this coming year, in London, Blockworks is going to be gathering 1,200 of the world's largest asset managers. So that's fund managers and allocators, financial institutions, think big banks, payment providers, etc., and professional traders at the largest institutionally focused conference in digital assets, DAS London. Now, it's very rare that you get the likes of JP Morgan, Goldman Sachs, Point72, the large HFTs, the family offices all in one room at the same time. So if you want to know what the big money is doing in digital assets these days, this is the conference for you. To give you an early sneak peek at some of the stuff that we're going to be talking about, one, the intersection of macro and digital assets, and where are we in the market cycle. We're going to be talking about real world assets, so that's stable coins, on-chain treasuries, all of that fun stuff. And we're going to be talking about things from the allocator perspective. So what are the big money managers in crypto doing these days? And because you are such a good listener of On the Margin, I'm giving you an extra code, MARGIN20. So click the link at the bottom of this episode. Again, use code MARGIN20, and I will see you in sunny London town in March.
Yeah, London is just it. Maybe it's just because I'm a history nerd, but it feels like when you walk around there, it just feels very rich. I guess rich is maybe a little bit
no, it's such a great adjective. It feels very rich, and rich not just in wealth, but rich in culture, in history, in opulence, in formality, and I love it. I feel like I'm transporting back. I just can't do the British accent. If I could have a British accent, my IQ points would go up so much.
Me too. I told you one of my best friends. He was my roommate, and I always like to remind him, like, you're playing tennis with a net down, buddy. He's also,
I know, it's just not fair.
And yeah, tennis with a net down. So, all right, let's get into stories here. I want to ask you actually about. So you've got your green pants and socks on here, talking about this Bitcoin candle. For those of you who aren't following along quite as well, I actually just want to show like this Bitcoin price action for the last. I was actually looking at this. I was just zooming out and looking at this over. We can actually look at it across multiple different time horizons here, but you really can't look at this chart at any given time over the last year and have it not just look extremely good. So
yeah, exactly. Yeah.
There's just no way that you can slice it. So this is the, kind of the 7-day, the 2-week, the 30-day, 90-day, 180, 1 year. I mean,
it's a thing of absolute beauty. So we're up 12% in the past 30 days. So it wasn't Moonvember, because it was Uptober, up 29%, but we have 12% in November. So happy December, by the way. And then over the last year, we're up 123%. And this chart is just so beautiful in that you have volatility, which we always do, and you even have a long period, almost 6 months of no movement, but you have higher highs and higher lows, a series of higher highs and higher lows. That is accumulation writ large. This is one of the great accumulation chart patterns that you will see. And if you go back to that 1 month chart, I think it is.
Yeah, here.
That is an absolute thing of beauty. And think about it, in this month, I tweeted about this the other day. In this month, okay, we had a U.S. government agency who shall remain nameless levy the largest fine against the largest crypto exchange in the world, of which it's questionable whether they had any jurisdiction over, but they still did it, forced the CEO to step down from his role. And this chart says, I don't care. I just don't care. And, maybe I need a new hashtag. Bitcoin doesn't care. It is in a massive accumulation. And I said, January 8th, King's birthday. That's the day I believe the approval's going to happen. And the party is going to get, we're going to have so much fun in London in March because we are going to be celebrating. I'm going to have to get 2 pairs of green pants. I'm going to get you a pair of green pants. We're going to have to walk around together.
If you give me, I'll wear a pair of green pants. I'll do that. I'll match. People will call us the Leprechaun Brothers. Here,
Exactly.
So let me add a little bit of, all right, so there's a lot to unpack there. So for folks who, I'm glad you brought this up because this happened a week ago, but we weren't, we didn't do our show last week. So CZ, the founder and up until very recently, chief executive officer of Binance, had a $4.3 billion fine levied at Binance. CZ has to step down. This came, by the way, from the Department of Justice, and the person who announced it, there was a smorgasbord of who's who. Janet Yellen, actually, the Secretary of Treasury, was the one who announced it. Notably missing was the SEC, by the way. But it was a who's who of U.S. regulatory agencies. CZ also had a $50 million personal fine from the CFTC that he's going to have to pay. He does not have to relinquish control of his shares, and after 3 years, he can operate Binance again. He may or may not. He may be still facing up to 18 months of jail time. It's the way that the plea works. It's kind of funny. It's like he can't appeal anything below 18 months or below in terms of jail time. But anything higher, and he can appeal based on the deal that he struck. And I believe he's actually in the U.S. right now. He was in Seattle for a court arraignment. And there's 2 ways to interpret this. And actually, it's been a bit of an interesting Rorschach test, because if you look at the mainstream headlines, and Jason was telling me, he got some inbounds from family being like, "Oh, this is horrible for crypto, another big blow, the other big exchange member." But trying not to be unbiased here, I can't see any way that this feels like very positive news for the market, because I think the one bear case that was sort of hanging over us here was the threat of Binance. Clearly, U.S. regulators weren't comfortable for it. It probably was the largest single obstacle standing in the way of a Bitcoin spot ETF. Now, seemingly that's been neutralized. And ironically, Binance now might be one of the safest places to trade crypto, because they're going to have to, get cavity searched on a regular basis by the Department of Justice. So doesn't it feel like a huge worry was just removed?
We've talked about this. The first they ignore you, then they laugh at you. It's like a bunch of nerds, geeks, play with your magic internet money, whatever. Then it became a threat. And they're like, all right, we'll kill it. We're going to kill it. And they've tried, right? Multiple times. They've tilted at the windmill, and the windmill just smacked them down, like literally smacked them down. Like, all right, we can't kill it. All right, you know what? We're going to take control of it. And here's what you do. You go after the highest profile. Stevie Cohen comes to mind in the hedge fund space. And $2 billion. It just 3-year ban. It's like, I've heard this story before. And you get a key figure to step aside so you can put your man or woman in the seat, and then you have control. And he can't beat them, join them. That's what's going on here. This is like a hostile takeover. And it's not like a full takeover. It's not like, Gary's going to sit in the chair and pull the strings, but this is absolutely all right, you're too big to kill, but we don't like you. And we want you to play by our rules. And we want you to pay for our budget for the next couple of years. So that's what they're doing. And some would call it extortion or bribery. Others would call it, cost of doing business. It's kind of like JP Morgan in jolly old England. They have a subsidiary that basically spoofs the price of gold all day long, every day. And they make $20 billion a year. And every once in a while, they get a fine of $1 billion. You can go back and read this in the newspaper, right? No one reads newspapers, but online you could find it. And when they asked the guy, are you going to keep doing this? Or he's like, are you joking? It's the cost of doing business, 5%. Of course.
Yeah, so I obviously don't really follow many enforcement cases. I do more closely in crypto. I think, at least I'll just speak for myself. I thought it was a little funny. It just rubbed me in sort of a weird way, where it was a criminal case, but you could settle it with money, which is just bizarre. Which is just a really bizarre idea.
It is totally bizarre. And what's even more bizarre, Michael, this is a great insight. It's amazing insight. So on the Stevie Cohen case, it was more civil, I believe, not criminal. And you could settle it without admitting guilt. You got to say, I am not admitting guilt, but I'm paying $2.1 million or $2.2 million, $2 billion. And I find this crazy that you can have a criminal, like literally criminal. But it may work that way for rich people. Maybe it's not, maybe the average person just doesn't understand that is the way it works.
Humans are just funny. I want to connect this, though, to actually some numbers and data, because one of the things that I think is being undercovered right now, or not discussed about as much, is the institutional bid that's returning to crypto here. And if I said, Mark, a couple months ago, what's the largest futures exchange for Bitcoin and ETH, would be really easy. You'd say Binance. Now today, I actually checked today. It is actually Binance, but for the last couple of weeks, CME has actually flipped Binance in open interest, which is huge. There's a great thread by Josh Lim here, who's actually he's ex Genesis, but really, really sharp guy. And he pointed out actually a lot of the stuff that I've been following, which is, well, one, he's got a much more intricate understanding of options and what it is to roll and stuff like that. But he's pointing out this the amount of people are paying on the CME an enormous amount, 23% annual to roll their positions between November to December, which is nuts. Which tells, safe to say, CME is a very institutional venue. So if you see volumes picking up there, that's most likely institutions that are doing it. If they're paying that much, what it tells you is like, that's not a long-term position. They're just trying to probably trade the Bitcoin ETF thing, but that's an institutional bid. I think the other thing to point out is some of the Bitcoin proxies, the exposure that you might get in public markets to Bitcoin, things like Coinbase and MicroStrategy and Bitcoin miners have been pumping. And just to remind folks, like these assets actually tend to perform even better than Bitcoin, or it's not better. There's just more beta. There's sort of this hidden embedded premium there, because it's seen as a way to get exposure to Bitcoin and crypto without actually having to go through any of the infrastructure or regulatory hurdles. So people, it's like, oh, well, if I think crypto is going to go up, I'm just going to buy Coinbase, MicroStrategy. That's the idea. And both of those have been absolutely pumping as well. So yeah, I mean, even now, this chart comes from a couple days ago, and I think Coinbase is at kissed 130 the other day. So
it's up well in, I think, like 250% year to date, and MicroStrategy's up closing in on 200% off the bottom. And to your point, what people I think miss sometimes is just the amount of money out there that is in these little boxes, these rule boxes. And there's 30 trillion by Eric Balcounias's, I think I'm saying his last name right.
Alcunis. Yeah.
Balcounias, yep. And, 30 trillion, big number, that can't at this point buy Bitcoin directly, right? But they can, in many cases, not all, buy things like, MicroStrategy or Coinbase because they're listed companies, as opposed to, they like, UBS won't let me buy GBTC, whatever. But when this ETF happens, that's going to be a dicey period because then it's like, well, I don't have to buy MicroStrategy, which is a questionable software business tacked on to a big honeypot of Bitcoin. And I don't have to pay a premium anymore for Coinbase. And I think Coinbase will do well because their business is going to skyrocket, right? Because they're going to do custody for these ETFs and they're going to, get ancillary benefit. And when the institutions really come, because yes, there's an institutional bid, but it's with this many people. I mean, yeah. I'm not, and I actually have numbers to back it up because I'm still smiling and dialing and trying to get people to meet. It's crazy how many people in the institutional world are still stuck on zero. Literally zero. It's 80+% of institutions. Now it's funny in the surveys, I think like 74% said, "Oh, we have exposure." I'm like, well, kinda. And what they're saying is, well, we gave some money to this venture capitalist. And we think they have some exposure somewhere. But yeah, okay, fine. But that's not you making a decision to buy a digital asset for all the right reasons, right? Reason to own digital assets is very simple. Let's just talk Bitcoin, and then we can go to the others. But Bitcoin is 0.0 correlated to bonds and 0.15 correlated to stocks. Those are the two lowest correlations of any meaningful asset class, like high yield bonds, hedge funds, private equity, international stocks. If you take anything with, kind of $500 billion and up of value, you could find small things like, stamps or coins that have even lower correlation. But for a meaningful asset class, this is the least correlated of all of them. And so when you add it to a Markowitz framework, meaning, when you take cash, riskiest asset you could ever own because you lose to inflation, and you add bonds, which have more volatility, risk goes down. In fact, this is actually an interesting story. So I did a guest lecture for a buddy over at Duke. He teaches a class on risk management at Duke. And I came in, a couple of things that were interesting. Not exaggerating, 90% of the class was from Asia. And so the Duke population, and maybe it's skewed. So the Duke population is probably a little bit diverse, but then there's the engineering school, which is a little less diverse. And then the people who are interested in risk management. I mean, we're talking some serious brain matter in that room. And that's not a racist statement that all Asians are bright, but these were really smart kids. And, I asked, so what is risk? First kid. And the hands like, they were up. And volatility. Like, I know that's what the textbook says, that is risk. And Dr. Markowitz used volatility in his famous capital asset pricing model. But that's not risk, right? Risk is,
it is if you're leveraged.
Well, it can be risk. It can be risky, but but definitely if you have leverage that any amount of volatility can be lethal, right? If you're 99% leveraged, 1% volatility can be lethal. But the point was that downside volatility is a better measure than total volatility, because why would you penalize something that has positive variance from a mean? And actually, Dr. Marquis said that I would have used semi-variance, but the math would have been too hard and I wouldn't have got the Nobel Prize. And actually, I think I've told the story before. I got to have dinner with him once and I said, Dr. Marquis, is that true? He said, of course it's true. That was $1 million prize. I wanted the prize. So yeah, I'm not going to, not get the award because I pure. I'm going to use the thing that everyone understands. So, but really it's total loss of capital, right? When you can't get to your point, if you're leveraged and you're forced to sell and you obliterate your equity and that's gone forever, you can't earn it back. Like if a stock goes down and you hold it and it comes back, that's not loss. I mean, Amazon went down 94% in 2001 and it's much higher today if you held it. Most people didn't hold it because humans are going to human. They sell what they're about to need. But anyway, so I just thought it was interesting how people are still stuck on this idea of volatility, and volatility is your friend. So what you want are assets like Amazon, like Apple, like Microsoft, not Microsoft. I hate Microsoft. That have this high volatility, but they have long-term accretion to your portfolio. But the reason you need Bitcoin in your portfolio, and all the institutions, every single one of them is going to have it. This is the crazy thing. Every single one of them will, and I've been saying this for years, right? Get off zero. I've been saying since 2017. And all that means is, and I said 10 years, and now we're, 6 years in. So it's only 4 more years from now. You will be deemed fiduciarily irresponsible if you have zero. I'm not saying you have to have 10 or 20 or 30, but zero is the wrong number.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later.
And so, all right. So I agree with a lot. I obviously agree with the get off zero. I mean, you're talking to, and by the way, none of this is financial advice. And I will say, just to put my own hand up, because now I'm risking editorializing with my own opinion here, but and I was very wrong at different points. If you go back to like 2021, very wrong on the timing and where we were in the regime, and all that stuff.
Sure.
So don't take all this with a huge heaping grain of salt. But I do think, obviously, I have turned somewhat constructive on this market. I'm getting more excited about it going up than I've gone and felt in a little while. And I do think on the, I don't know, I've started to just think it's kind of like that conversation that we had a little while ago about I was talking to this guy in one of my really early formative sort of experiences at Blockworks, and I was trying to say, well, okay, many of these these little like ICO S coins or whatever going to zero, but there'll still be these successful ones like Amazon, right? Amazon has dropped down 90% 3 times or whatever in its existence, and he's like, well, we'll see about Amazon. So, and that experience cemented to me that there will be some people that this could rip in their face for 20 years and they wouldn't change their mind. And actually, this is the people who are supporters of gold bemoan the same thing, right? Some of the smartest macro minds I know are like, people have got to get off zero on gold too. And I think there's some amount of rationality to it. Like I was actually going back and looking for Urian Timmerer, who is at Fidelity, basically shaped my whole view on this with 2 charts. Now this one chart that we're looking at here is gold as a monetary hedge. And the other chart, if I could find it, which I unfortunately can't, is he charts going back to 1780 or something like that. The return of various asset classes. So he's got yield bearing cash, bonds, equities, gold. And what it shows you is equity outperforms. Yeah, equity way outperforms everything else. But then yield bearing cash and debt is below, and then gold actually underperforms. And so taking these two things together, and sorry, this chart, by the way, for folks who are not following along via video, shows you the growth of money supply and then what gold plus Bitcoin do. And it doesn't go up in it doesn't go up in a straight line. It goes up in these crazy, these spikes, right? And this tends to correlate with, look at it, inflation. So it goes up in the 1940s, goes up in the 80s, and it's been trending back up again. And so taking these two things together, what it tells me, and people are going to hate this because the hodl meme, this looks more like a trade to me than a long-term hodl till I die. And not that it might not play out like that, but and that kind of foots with this growing conviction that I'm starting to have of these, especially layer ones like Ethereum, Bitcoin, Solana as commodities. And really what a lot of these investors, I think, are waiting for are businesses that have equity-like returns that compound. And we haven't really seen a lot of that yet. And actually, this should be taken as an extreme positive, because I remain extremely optimistic about the businesses that you can build on these substrates, these new tech platform substrates. And I think that actually, so some amount of new capital is going to be unlocked by, frankly, just the price of Bitcoin going up, its lendiness, it's more liquid, so larger funds can buy it. But I also think we have to build apps and things that people want, and that will unlock a whole new set of investors as well. Sorry for the monologue there, but that's
no. Look, it's 100%. The only thing about this chart that I do think is kind of funny is the only reason stocks look like they go up is because of what gold does. We're pricing those stocks in the toilet paper.
And you know what?
Which went from $1 in 1913. Okay, so from 1776 to 1913, $1. Just remember, we took from the Dutch, the Rijksdollar, because they invented the first central bank. And, so the dollar was 1776 to 1913 worth $1. It had two fluctuations around the wars when, we made other things like Confederate dollars and all that. But the bottom line is the dollar is worth $1. 1913 to today, it's lost 97+% of its purchasing power. So when you price equities in dollars, they look like they go up. If you priced the S&P in gold, not so much. So that's the dirty little secret. In fact, stocks, and this is just a short period of time, stocks today priced in gold are the exact same price they were in 1997. Mm-hmm. Okay, and if you take it all the way back to when when gold was like $30 and they fixed it, it's worse. And so what happens is this devaluation of the currency creates money illusion. You feel like you're richer. Your house goes up and your stocks go up. But remember, that only applies to the people at the tippy top and the all-seeing eye. The people at the bottom don't own stocks. They don't own houses. They have a fixed income in terms of minimum wage jobs, and literally they subsist on government handouts. What's her name? Liz Ann. Is it Liz Ann Saunders? No, Liz Ann Saunders. I think it's Liz Ann.
I'll get it. Yep.
But she's from Schwab. She had a great chart this morning that showed that the percent of personal income from government subsidies is back down to pre-COVID levels. So we had that massive spike where everybody said, "Oh, everybody's income went up." I'm like, are you joking? They sent you money. That's not income. That's a windfall. That's not income. That's not coming again. And it had this big spike up, and it's just been deteriorated, and it's now back to below where it was. There you go. And the that is, there's a whole bunch of people, like out in Coweta, Oklahoma, where I just was. Every mini mart or a convenience store you go by has a big giant sign, we take EBT, the electronic cards, the food stamps cards. And one of my favorite stats, but it's also one of the saddest stats. Do you know when the largest percentage of Walmart sales occur?
No.
Actually, it just happened about 8 hours ago. From 12 midnight to 1 o'clock on the first day of the month, they get 10% of their revenue for the month.
Oh, man.
Because people get their card reloaded at midnight on the 30th or 31st, and they go shopping and they're there. And as soon as that card gets reloaded, because they ran out of money halfway through the month, and they load up the car with baby formula and diapers and food, and they check out, and they get 10% of all of their revenue. That's a scary stat. That one hurt me the first time I heard it. It was just.
I was going to say that kind of bums me out.
That's but that said, back to the good stuff. When you have a currency, a fiat currency that can be devalued, as we've seen all over the world, you can protect yourself, and you don't have to have all of your money. That's the cool part. Is you don't have to totally get out of the fiat world. I mean, someday maybe we'll get there. I was just at this cool event. So I was at the Future of Bitcoin Mining event in South Carolina, and Jack Dorsey was there. And now, why would Jack Dorsey come to middle of nowhere, South Carolina? Because we were literally in the middle of nowhere. It's this really, really cool thing, firm called Barefoot Mining. And they found that there are 450 odd sites around the country that during the New Deal, right? When they put people to work because they got laid off during the Depression, they built these dams across a bunch of rivers. And they're not like the big Hoover type dam. They're these really cool little dams. And then the industrious textile mills and anyone who needed electricity created these little chutes and collected the water and made electricity. So this thing's been abandoned for 100 years, and they bought the property and they got the stuff to work. It's like the original 1800s and 1900s machinery, and they put a big new generator on it, and they are getting free electricity to mine Bitcoin. And Jack Dorsey was out. He had invested in this company that Luke Dash, one of the core developers, is putting together to create a new mining pool to keep decentralization strong. But what was interesting to me about that is, one, we are, like I said, middle of nowhere, South Carolina, and there's this new age, business that's happening using old, age machinery, and it's a recognition that this stuff is, one, here to stay. Two, that there are really interesting ways to integrate it into what we do every day. Now I totally forgot where I really went down with that story, but anyway.
I have a Bitcoin mining. So one thing I've actually been doing, just a super nerdy thing to do, but I've been going back and listening to these old Epicenter podcasts that took place when the Bitcoin block size wars were happening. Epicenter is probably the oldest long-standing crypto podcast. Goes back to 2014. You should go back and listen to it. It's super interesting. I actually listened to a podcast from 2014. A big institutional conference in London was happening. There was the moderator was CoinDesk, and they introduced themselves as, you might have heard of us. we're a little upstart called CoinDesk. It's so funny. And
That's so funny.
their topics were he outlined like the big themes that everyone's talking about. The three that I can remember are everyone's too focused on price. Isn't that so funny? A Bitcoin mining ban has been reversed in China. Super funny. And U.S. regulators are starting to look more at crypto. So you could literally superimpose all three of those things on today and have it not skip a beat. And
we should just have that be the topics for DAS. I mean,
right
there.
That actually all relatively applies. So it's
10 years later.
But you can go back to these Bitcoin block size wars and listen to the debates that people were having at the time. And I would just encourage people to do it because I think history has repainted it a little bit as like, a clearly good and a clearly evil side, as opposed to the way that at least I like to look at human conflict, which is sort of struggle for control, competing visions between different stakeholders. And anyway, there's a lot of interesting nuance there. But I actually wrote a newsletter about Bitcoin mining and the value chain of Bitcoin mining and how it reminds me of the value chain of steel. Because I used to, in my past life, I was as a consultant that worked at this little shop that specialized in helping people procure steel. And I had to once a quarter work on this thing called the Steel Report, which is this thing that we used to gin up business. We'd send it out to people like, hey, here's what like steel is doing. I hated it because it would I had to do it on top of my own work. Everyone else was doing it on top of their work. So it'd be like 4 a.m. nights where it's like, where did you find the price of this? And I was like, oh my God, this is terrible. But I did learn a lot. And I learned a lot about how commodities behave and determine price across value chains. And I thought that there are 3 raw material inputs for steel: iron ore, coking coal, and steel. Because when you cut steel up in these things called service centers, that's called scrap. And then that gets all boiled together and melted down and reused in steel. So steel is an input cost for steel that trades on kind of the second correlated secondary market. And I used to think that the price of steel would be determined by iron ore or coking coal going up, because as the price of raw materials go up, the price of the end product has to go up. And that's how it behaves half the time. But half the time, I would see these headlines that was like, iron ore up on the back of of steel prices going up. And I thought to myself, how does that make sense? Why that is reversing the causal error of how I think prices are supposed to work. Like, why is steel leading the price action here? And what I figured out after like a year of putting this report together was that there are separate markets for the raw materials, iron ore and coking coal, and steel. Steel sometimes will respond to its own price, supply and demand dynamics. When that happened, the steel producers started to make a ton of margin. The other guys in the value chain understood that the steel guys were making the margin and they would raise their own prices. And there would be this like game of hot potato for margin in between this value chain. And I think that's what happens in Bitcoin too. And the analogy would be mostly what drives Bitcoin is the supply and demand of something like Bitcoin, right? Bitcoin block space really is the commodity. But there's this very complicated value chain of raw material input cost of miners and electricity. And if you look at mining, the revenue of miners, in a funny enough way, that actually sort of the price of Bitcoin kind of sets a floor. There's a floor in between the mining revenue and the price of Bitcoin.
Absolutely, and it gets crazier because of the way it was coded to have the rewards,
right?
And
it's awesome. I'm such a fan of Bitcoin. It's just such a wildly.
Well, and the thing is, you got big B Bitcoin and little B Bitcoin, right? So there's Bitcoin, the commodity, and it is a commodity. It's digital gold, the unit. But then there's the network, and the network is becoming increasingly valuable with things like ordinals and other things.
Taproot Wizards,
the block space,
Taproot Wizards, baby.
Yeah, and so when you think about, I said this, and I don't know if I said it on this show or somewhere. No, I was at a conference, and I said, and people are all mad, and the maxis love it, and everyone else is like bullshit, and I'm like, look, I believe it's possible that Bitcoin is the global settlement layer for all assets. Certainly possible, and we're like, no, it's ETH. ETH has more activity. I'm like, no. The activity of trading the token is not what I'm talking about. I'm talking about final settlement of where do you want the ownership record of your home or your car or your business, I think you want it on the safest, most secure, biggest network. Again, if we're going decentralized instead of centralized, if you think about where do you want your valuables? In the old days, you put them in the safe deposit box at the bank. Why? Because the bank was a big, fancy building made with marble columns and thick cement walls, and it was safe. At least you thought it was safe. And we all have seen the movies of the bank robbers, and they, tunnel in, or, they weren't as safe as we thought. So then what we do? Well, then we said, all right, well, we can protect it by going away from analog stuff. We won't put our analog stuff. We'll electronify stuff, and we'll store them in trusted institutions, banks, brokerages, etc. And that's been pretty good. But I have 106 messages on my password thing. The new update now, Apple will scan all the data breaches and tell you when your passwords have been exposed to a data breach. I have 106. The fact that I even have 106 passwords, and I actually have more than 106, is ridiculous. Ridiculous. Like, when are we going to get real tech to replace that? Somebody please send me the business plan for that. I will fund you, please. It's the dumbest thing. Passwords, dumb. Anyway, so this idea that the network itself is going to be an increasingly valuable place because it is so decentralized and so secure. I'm so bullish. I mean, it's crazy.
I'm with you, but
I know.
I'm with you ish, because here's so where the most, I gotta actually double check this, but at least, okay, where stable coins, right? Killer use case, $100 some billion. I could actually check this, $100 some billion worth of market cap that exists today, extremely high velocity, yada yada. You know where most of that settles down to? Tron. So I don't know. I just I'm with you and I hear you, but I don't know.
And look, and that's actually, it's actually very logical, right? Because in the early days of a business, what do you optimize for? Speed and cost. Ultimately, after you have that first loss, you optimize for safety, right? How many businesses have you seen, right, that got going and then there's a big problem, right? Their warehouse gets, raided, or their trucks get intercepted. It's kind of like, I remember, how many years ago did Bezos show, we're gonna have a big announcement. He's like, drone delivery. You ever got anything delivered by drone to your house? No, because it turns out if there was a bunch of drones flying around, some bad guys would shoot them down. And so they got to figure that part out. And then you got an FAA problem. So there's a lot of good ideas.
That's a really good point. Anyway. One thing, the reason and then I want to bring it back here to the spot ETF and some of the action that's going on CME. One something I've noticed about this industry is it is very cyclical. That's not a unique observation, but the talent that tends to migrate into crypto is tech. It's people with a tech background for obvious reasons. But the way tech has behaved, at least for the last 20 some years in the US, is, blips, but mostly a one-way street up. And what that has meant is the strategies. First of all, people have only known sort of these up markets. And the strategy for tech is because they're not high capex businesses, not high fixed cost, and there's zero incremental cost of producing something new. And because of this up only dynamic, the idea is raise as much money as you can, spend whatever you need to spend on the engineers. The valuations will be nuts, and that's your strategy. And that's that's the game that you're playing, is to get this in early momentum. But that's not the game you're playing in crypto. It's a different game because the industry has these crazy boom busts. And if you operationally lever yourself up, you are gonna eat it the next
Yeah.
cycle.
Yeah,
And it's
yeah.
a totally different mentality. And the industry's really split in terms of they have these debates and they're highly relevant, not just for like investors who want to speculate on price, but for people who are trying to operate a business. We're having a big internal debate when we forecast revenue out. Do we build in market cycles or not? And it's been actually a massive problem for us in the past because we have done what most people do. We linearly extrapolate the revenue. So if it's going up like this, then we're going to say, okay, we'll probably continue that trend roughly. But it doesn't behave like that. And
Yeah.
so it's always
Yeah.
wildly wrong. And so
Yeah.
then it's like, well, do you just accept that it's going to be wrong? Or do you try to build in the market impact? But then the market impact, you're basically trying to guess at the market impact. So how do you do that?
Yeah. Well,
It's really tough.
Your point. What everybody does is up and to the right. Every spreadsheet you've ever seen, every pitch book I've ever gotten, always up and to the right. And how much to the right is just how bad you are at Excel. Right? The people who are good at Excel realize that the discount rate is wrong, so they adjust it or they change their growth rate. But the people who are bad at Excel, they just plug in a formula. Oh, look how much money we're going to make. And it's like, oh, please. Okay. Cyclicality, competition. Because, it's interesting. History is written by the winners. Right? We are students of history, and it's fun because you're reading the good stuff. But it's not written by the losers. And so, yes, tech looks like it's up only. Oh, au contraire. There are lots and lots
All right. That's good.
dead bodies along the way. I'm not disagreeing. Your point is actually right, but it's the component of success. Like for every Apple that started a garage, right, 99 other failed. And there are companies that start off and they look like they have an edge, and then someone outcompetes them, and they literally but they fade away. Like there's a company, Digital Island. You ever heard of Digital Island? No one's ever heard of it. We made a ton of money off this thing. They basically created a data center in Hawaii because it could optimize moving network traffic because of the undersea cables, and it took the low, like the speed would decline the longer the cable. So then they would boost it so it could get faster. And it was an interesting idea. And then Sienna came along and expanded the capacity of fiber optic cables using light, and they went to zero. And no one's ever heard. Or there was Puma Technology, which was some printing software that was going to make out of the printing gone. So the ones that win, definitely up only. But along the way, there are these dead bodies. And what I think is interesting, to your point on the application layer. So in the internet, all of the wealth is in the application layer. You can't own TCP/IP. You can't own HTTPS. You can't own SMTP. Just none of it is at the protocol layer. The companies that built those protocols, most of them government agencies, but there were some private companies that tried to commercialize the tech. Nope. All of the value in the application layer. So far in Web3, or third generation internet, whatever you want to call it, 85-ish% of the value is in the protocols because you can actually own them. But people say, well, but am I really owning them, or am I just trading shitcoins? Well, yeah, a bunch of them are utility tokens and you don't really own anything. Okay. But there are some real ownership. And I would put, Bitcoin and Ethereum and Solana and a handful of others into that category. By the way, Solana, I am taking full credit for the pump again, that since I changed my mind on Solana, it's up 6x. It's crazy. It's up a lot.
Look at the NFTs on Solana. Those things are doing numbers. And there's a community, baby. There's a community presence.
Well, there's a community and there's a supply demand imbalance. But anyway, it's doing great. And but builders are actually building stuff. And so if I think, yes, they'll be classified as commodities, I think the good ones. But at the end of the day, I think Bitcoin is the true commodity, like gold. Gold is both a commodity and a currency. It has its commodity uses and it has its money uses. It's the base layer of all money, right? Every central bank owns it. They build the money on top of it with debt. Great. I think Bitcoin replaces that. And Hal Finney actually said that, which is amazing. He's, said it 9 years ago. Crazy. He actually said this is going to happen because it has lighter weight and greater anonymity than gold. And so that is the true commodity layer. I think Ethereum, Solana, maybe a few others become more application layer. And then they got to be integrated with other real applications like L2s, L3s, L4s. And that business starts to accrete more value. So right now it's really Coinbase and a few others that captured value in addition to the protocol value. But the app layer hasn't even happened. Why? Because we're 1 month away from the beginning. This is the cool part. The story of the Bitcoin era, the blockchain era starts January 1st, 2024. 54, 68, 82, 96, 2010, 2024. The 14-year cycle starts January 1st. And then we run 4 years where it's awesome. And then we have a bust. And that bust kills off a whole bunch of also-rans, right? It kills off the pets.com and it kills off the web vans to then be rebirthed for the next leg up, which is the killer leg up. Okay. And that's when the fun starts. So
you think 4 years? We're going to get 4 years of bull market here starting in 24?
Well,
fire me up.
I mean, not full, because there'll still be the 4-year cycle that's different than the 14-year cycle. So that's built in. So it all depends, Michael, how bad the next bear market, which will happen, kind of June of 25-ish, kind of June to November of 25. Maybe it moves to November of 25. But how bad that one is dependent on how crazy the parabolic move above fair value. So fair value is going to go from 50 to 100 with the halving. Do we go to 150? Do we go to 200? I was with Max and Stacy. We're at this event in South Carolina. And, Max is back saying, 220's in play again. 220's in play. I'm like, stop saying that. You said it last time. And look, Max, this is funny. So there's this guy, Tobias, who's created the Bitcoin mining museum. And he's got the original jalapeno that Adam Back used. I mean, he's got some amazing, and I tweeted this out. There were USB miners that were getting 50 Bitcoin every 10 minutes. An S19 today has 1 million times more power than that little USB miner, and it gets 6.25 in 10 minutes. I mean, the mind is just blown. But he has this McLaren shoe, and he's having all the Bitcoiners sign it. And you got Adam Back to sign it, and he got Jack to sign it. And Max signed it on the tongue, which is hilarious because Max is our tongue, right? He is our spokesmodel and our high priest. But if we go to that crazy 200 level, then the bear market will be bad, right? Because if you get so far above fair value, then it's gotta drop. But I don't think there's going to be as much leverage this time. I really don't. So I don't think we're going to go as crazy. And so I think the cycle will be more up-ish, less downish, and then more up-ish.
I have a lot of thoughts. I've got a prediction for you, which is I think we're going to get the same amount of leverage. And I actually think this is because it's not in Bitcoin, but I can see a structure that's starting to form that would encourage some amount of leverage, which is
humans are going to human. Back to our first statement today.
Humans are going to human. So if you look under the hood at a lot of protocols in DeFi, they look really similar. Actually, they look really similar to sort of like a bank. Like if you look at a bank, it's you got balance sheet liabilities in the form of customer deposits, and there's a little surplus of equity, and then there's assets, liquid treasuries, loans that the bank makes out, etc. All right, let's look at a protocol like, sorry, now I know we're getting into the weeds here, but something like Lido, right? You have callable deposits in the form of stETH. That's what, Lido, the protocol, issues to you. And then there's a little bit of an insurance fund. And on the asset side of their balance sheet, they run a bunch of validators that earn yield, which then they then pay out. Okay, right? Similar sort of look. Now there's a new layer 2 that just got launched on Ethereum called Blast. Okay, what is Blast? They launch as a multi-sig, which is basically just a way to take funds. And what they're doing when 640 million, which is the amount of money that is funneled into this little multi-sig, which is run by a 24-year-old, who's running 2 companies. What they're doing is they're routing those funds to Maker, which they're earning yield on treasuries, and they're routing it to Lido, and they're earning stETH yield. But that basically looks right like that looks like the same structure actually as like a Celsius or something like. And now it doesn't need to play out the same way. But my worry is that people are going to be like, see, now we don't need to worry. We're not doing these centralized opaque exchanges. It's on chain. Don't worry about it. We can see. It's like, yeah, but like 100 people realistically know how to check the chain. The amount of people that can actually read the code is so low that eventually all of this is right, and being on chain is going to be that's going to be the default. All right. So one quick, because I know we got to run here. We're going way over, but what this thread that I surfaced that Josh Lim wrote, basically he's saying that the premiums that are running up on CME imply that this could be a profit taking or de-risking event, in advance of the official ETF. And I think what a lot of people are actually asking themselves is this ETF, if we were to get it, a buy the rumor, sell the news type event?
Nope. Dan Moorhead put out the paper, buy the rumor, buy the news. No, wait. The money has not even started to come. It's different, right? It's different than the futures ETF, which that was buy the rumor, sell the news, because futures, they can get naked short on the other side, which is why they approved the futures ETF in the first place. So the banks could go naked short and push the price down so they could accumulate at a lower price. That's been going on for years. This is real. Like this, in this world, you don't get to make paper shares. You got to buy the Bitcoin. And so the amount of Bitcoin that's going to get bought as the money starts to flow into this, and go back and look at what happened with GBTC. When GBTC started to take money in, we went from 10 grand to 60 grand in like 11 and a half seconds. I mean, it wasn't 11 and a half seconds, but it was pretty, just go back and look at that first run up. And then Elon did his tweet and we went down in 50%. We went down 50% on a freaking tweet. And then we went all the way back to 69 because because fair value was 30 and we got to, 2+ times fair value. And then we had the bear market. So is this going to run, from 30 to 180? Might. In fact, it might run more because the amount of money that's going to go into this ETF, big, really big. I mean, it's just big. It's just big. And there's no other place it can go but spot Bitcoin. It can't buy anything else. It has to buy the actual coins. And that's different. And the problem is there aren't that many to buy because you got the lost or stolen. You got the locked, right? Where there's a multi-sig problem, or you got the hodlers. Now, I'll never sell. There's a price. There's a price for everything. And that's the way markets work, right? So I won't sell. Would you sell at 100? No. Would you sell at 200? No. Would you sell at 500? Maybe I sell a little bit. And it's the funny story, and I'll leave you with this funny story. So at Chapel Hill, there's a fancy street called Franklin Street in the middle of town. Separates the university and the town. And there are these nice homes along the way, and they're old, but they're nice. And back in the day, this 20 years ago, there's this very wealthy guy, C.D. Spangler, who came into town, and he walked up to this guy's house. He had a historic district house. He said, "I want your house." And the guy's trimming his hedges, literally out trimming his hedges. He says, "Well, it's not for sale." He says, "Well, sir, everything's for sale. What's your price?" And at the time, the house was like 300 grand or something. He says, I don't know, $1 million. Whips out his checkbook, writes the check for $1 million, hands to him, says, all right, I'll send my people to close. It's like, what? No, well, you said $1 million. So, and he didn't have to, but he did sell the house. He's like, $1 million? You're really going to give me $1 million for this house? But now that house is $3.8 million. But anyway, because the house didn't get better. The money got worse.
True.
So,
All right. In closing,
Bitcoin.
I'm actually just looking at someone. I don't know. I want to give a shout out to Peter, who, Mark, you and I on the margin were his most listened to podcast. People are posting their Spotify Wrapped. He's a top 3% listener. So shout out. And Mark and I appreciate so much you guys spending your mornings with us on Saturday. If tweet it out, we'll retweet you, comment, all that stuff, and would love to see listeners of the show. So we can close with that. Mark, best hour of my week. This was a really good one. So
always 2 weeks in one. Good to see you, man.
Cheers.